What's going on, everyone? The GameStop mania has continued to take over everything that you hear on the market, but there's a couple things you should be cautioned on if you are thinking of getting involved or if you're already involved. Times of hype like this can create tons of volatile markets where the prices go up and down really drastically, and although it might seem like it's really easy to figure out when to actually time the market and get in or when to actually time the market and get out, there's a lot of reasons why that's actually really difficult and probably something that you might be doing that's putting more money at risk than you actually need to be. If you want to get involved, that is totally up to you. This is not necessarily investing advice, but I looked at some charts and I just want to kind of walk through some other stocks that have had similar situations to this, also the dot-com bubble, and just kind of show some similarities and things that you might be able to take into account so that you can make better decisions as well. So if you're new here, my name is Quinn, this is QuinnTalksMoney. If you're a subscriber, thank you so much, I really appreciate it. The last few videos have kind of taken off. We've got GameStop Part 1 and Part 2 that you can probably find on my channel. Watching through the whole video will allow you to make a more informed decision so that you're not stressed out and you're able to feel more comfortable with your financial decisions. In times of hype like these, it's most important that you stay informed and aren't just listening to the masses, so that you're able to be more financially free in the future and feel comfortable with the financial decisions and investing decisions that you're actually making. The first word of caution is coming from an investor. His name's Jeremy Raper and he runs an online trading group. And he has some really great advice just to keep in mind, because in times like this when everyone is giving their opinion, including me, there is a ton of noise out there. And sometimes it can seem extremely stressful or extremely mind-boggling as to what's going on, because people are telling you one thing, someone else is telling you something else. So just remember, in these times, focusing on your own mindset and figuring out information for yourself can be really helpful. Even though it seems daunting that there's lots of information out there, I believe in you and I know you can do it. So let's hop into this first piece of advice right here. Jeremy says, think a lot, do a little. Higher volume is like driving in a rainstorm. All your actions have way more impact and everyone else's do too. You should be trading less and thinking more. So I think this analogy is just really strong in being able to help us understand that when things like this, high volume, it could be trading, it could be news, it just could be anything that's going on, you really have to be focusing on the things that are, in this case, going to be keeping you alive. A rainy day in this example is really like when the stock market is being really hectic and it seems chaotic. So in a time when the stock market is really chaotic, it can be really hard for you to actually correct yourself if you make a wrong move. So if you make a wrong move when the stock market is in a hectic place, in a very volatile place, those moves can have way larger implications than on a day when the stock market might not be volatile at all. Maybe you make a bad trade or maybe you make a good trade. The consequences and the benefits are just evened out or smaller compared to a day when it's rainy or a day when the stock market is extremely volatile. There's tons of news, tons of people telling you what to do. So the takeaway from this one is just think a lot more in times when the stock market or people are very hectic and chaotic, and allow yourself to think through some of these decisions you're going to be making, because they can have bigger consequences than in times when there's less noise and less news actually going on. Got one more here from Jeremy as well that I think is really important for you to also remember. So Jeremy says, simplify, narrow your focus, know what you own, be prepared to deploy capital if things get truly insane. But don't rush into new names or jump outside your circle of competence. When volatility goes up, errors of commission are far more costly. Stick to your knitting. So the takeaway from Jeremy here is that rushing into new names or rushing into things you don't know can cause you to make extreme errors of judgment. And those errors of judgment can have huge consequences, where if you're buying things that you don't know, it doesn't allow you to actually determine when is a good time to buy or when is a good time to sell. So all you're able to rely on is news and what other people are doing, and that puts you at the mercy of a lot of people that also might have no idea what they're talking about, or they might have malintent and be trying to get you to buy a stock so that they can make a profit off of you. So in times like these, when things are hectic and crazy, even though it seems like everyone's getting involved and everyone's making a ton of money, it's really important that you stick to what you know, and also that you are able to maintain a cash position. So if you do want to invest, you're actually able to then deploy the capital when you find something that you know that is at a good price, rather than having to follow the crowd and do something that might actually create more risk for you in the long run and might actually cause you to lose your money. Another example I want to share with you as a cautionary tale is another stock that a lot of people have been talking about that's similar to how GameStop was a couple years ago, and that stock is called Tilray. And they're in the cannabis industry, and they had a similar run-up where their stock was bought like crazy, the stock skyrocketed, and then it's now had a long decline. What you have, if you look right here at the start, this is where the stock, they initially went public. So they went public, the price was about, let's say, $24, at its low, kind of when it went public. And then all of a sudden you have this huge spike up here. So it's going up about 6x here from its low of about 25 all the way up to the top of 146 or 150, about 6x. So it's a huge jump from just, let's say this was in August up until October. So over the course of 2 months, it's 6x'd, and then all of a sudden, what do you have? You have this super long decline all the way to the present, where now, just currently, the stock price is about 18. And just looking at the stock price doesn't necessarily tell the whole story. This is a very simplified view of what we're looking at. But the idea is, for all you know, how did you not know that this right here would have been the top? Or how did you not know that this right here at 123 would have been the top? Because for all anyone knows, once it got to $150, a ton of people might have been saying that it would get to 300. But then all of a sudden, boom, you got a drop. You got drops. And it just drops and drops and drops and drops. And so the risk here is, although you might buy it at the right time, maybe you buy it at 25 and you sell it at 150 and you just perfectly time the market, but knowing when all of these things are going to happen can be extremely hard. So it is extremely hard to be picking stock prices and timing the market. And I think this Tilray example is just an idea of how GameStop might happen. We have no idea what's going to happen with GameStop. But this is just an example of how, things could happen where just a really long decline until it actually, becomes a logical price based off the future growth or the earnings of the company as well. There's also some cautionary similarities between what's happening right now and what's been happening in the last year and a half or so, and what's happening with the tech bubble. So I'm going to talk about those right now. If you're enjoying this video and getting something out of it, I'd really love if you could like it. And also if you're new here and you want to subscribe, I would really appreciate it. I'm doing my best to grow this channel. I really appreciate you being here. So let's jump in right now to the tech bubble and how it relates to what's going on with GameStop right now. During the tech bubble, we're just going to kind of read our favorite source, Wikipedia here. So look at this right here. We've got a decline in interest rates increase the availability of capital. Think of what's going on right now. Interest rates are at an all-time low. You can refinance your house for like 2.5%. So interest rates increase the availability of capital, which means more people have more capital, have more money in their bank account. The Taxpayer Relief Act of 1997, which lowered the top marginal capital gains tax in the US, also made people more willing to make speculative investments. So even though right now the economy is in a terrible place and a lot of people are still unemployed, there's also these stimulus checks that have been going out. And a lot of people haven't been spending as much money, so their bank accounts have more money in them. And because of that, people are more willing, in this case, also a similarity, to make speculative investments. And as a result of these factors, many investors were eager to invest at any valuation in any .com company, especially if it had one of the internet-related prefixes of .com in the name. So here we are, where people don't even care what the company is doing. They don't really care about the valuation or what the company is actually worth. They're just putting their money into something because that's what seems to be the right move. And that can create a lot of issues. It creates a lot of speculation and it creates a lot of disjointed valuations from where things actually should be. So here we are again. An unprecedented amount of personal investing occurred during the boom, and stories of people quitting their jobs to trade on the financial market were common. The news media took advantage of the public's desire to invest in the stock market. Hype. Everyone's creating hype. Quitting their jobs to go trade on the stock market. Now, tons of people still made money in the tech bubble, but as we're about to see, there were some huge declines as well. The bubble in telecom was called the biggest and fastest rise and fall in business history. So here we are, we've got a huge rise, in this case GameStop, and again, not necessarily saying that everything that happened in the tech bubble will happen with GameStop or these other stocks as well, but when you have these really speculative investments that are happening, it can have a huge rise and then a really quick fall as well. And so that's, again, just like a similarity that might actually be happening here. So all of this stuff is just a cautionary tale of how just because you're hearing something online, or you might be hearing your friends do something, or the stock price just keeps going up, does not necessarily mean that you should jump into it right away. Now this, again, is not necessarily direct investment advice that I want to give you. I'm just trying to caution you, even though this GameStop hype is super exciting and is really interesting to be reading about, just because the stock price is going up does not mean it will continue to go up tomorrow. It might, who knows, from here it might 10x. But at the same time, at some point, it'll probably come back to earth and get to a more reasonable valuation. When that's going to happen, I don't know. It might happen in 5 years. It might take one day to get to that point, or it might take 10 years to get to that point. But the idea is make sure that you're being cautious with what you're doing. Do not be investing money that you're not willing to lose, and also just try not to get caught up in the hype, and just be aware that you have the ability to do research as well and think about the things you're investing in, because over the long run, a slow investment that's able to make money for you in the long run is better than one that makes you money in one day, but then you lose that money the next day as well. So thanks for being here on QuinnTalksMoney. I'll see you around. Who knows what's going to happen in the next day? If you can subscribe or like, I would super appreciate it, and I will see you next time on QuinnTalksMoney.